All right, let's unlock some serious knowledge. Welcome to the deep dive. Today we're plunging into a topic that, let's be honest, often feels like a giant, intimidating puzzle with a price tag: estate taxes.
Mm,
But don't let that overwhelm you. Our mission is to transform that puzzle into a roadmap, showing you how to navigate these waters not just to understand them, but to potentially save a significant amount of money and truly preserve your legacy for your loved ones.
indeed. And we'll be sifting through the complexities of Form 706, that's the United States estate, and generation skipping transfer tax return and its, accompanying instructions.
Right.
Our goal is really to pull out the most important actionable nuggets of knowledge. We're specifically focusing on the powerful strategies and elections designed to help you, our listener, significantly reduce estate tax liabilities and safeguard your legacy.
Think of this as your shortcut to understanding how to potentially keep more of what you've worked so hard for, all based directly on the official guidance. We'll explore various tax-saving methods, crucial exclusions, savvy deductions, and intelligent valuation choices that can truly make a real difference to what you pass on to the next generation. Let's get started. So, to begin our journey into these strategies, we first need to lay the groundwork. What exactly is the purpose of Form 706, and what kind of tax are we actually talking about here? It sounds like something exclusively for a tax professional, maybe, but I suspect there's a lot of practical insight buried within it for everyone.
You're absolutely right. Understanding the foundation is the first key to unlocking its potential. Form 706 is primarily used by the executor of a deceased person's estate to, well, calculate and report the federal estate tax. This tax is imposed by a specific chapter of the Internal Revenue Code, Chapter 11. Now, here's a critical distinction, and it's often misunderstood.
Yeah.
This isn't a tax on the beneficiaries or on the shares they receive. Instead, this tax is levied on the entire taxable estate of the person who has passed away.
Oh, the whole pot,
Oh,
basically.
exactly. It's essentially a transfer tax, a tax on the legal right to pass property at death. So think of it as a final accounting and a toll collected by the government on the total value of assets transferred from the deceased to their heirs.
So it's not about what I as a beneficiary get, but what the estate holds before anything is distributed. That's a fundamental difference, and it immediately shifts how you'd think about estate planning, doesn't it?
Precisely. And beyond the estate tax, Form 706 has a secondary but equally important use, figuring the generation skipping transfer, or GST tax.
GST tax.
Yeah, this tax applies specifically to direct skips, which are transfers to individuals or trusts that are like two or more generations below the deceased person's generation.
So grandkids, maybe.
Right? Transfers directly to grandchildren or even great-grandchildren. It's designed to ensure that transfers that, bypass a generation and thus avoid estate tax at that skip generations level are still subject to a transfer tax.
Okay, closing a potential loophole there. So it's covering two distinct but related taxes in one go, acting as a comprehensive report for wealth transfers at death. When does an estate actually need to file this form? Is it for every single person who passes away?
Oh, no, not at all. For decedents dying in 2024, Form 706 must be filed by the executor of the estate of every U.S. citizen or resident whose gross estate, combined with any adjusted taxable gifts made during their lifetime, exceeds a certain threshold.
Gross estate. What does that generally include?
Imagine everything you own at death: your home, your investments, retirement accounts, maybe life insurance proceeds, even that valuable art collection. That's broadly your gross estate.
Got it.
Now, add in any significant gifts you might have made during your lifetime that were taxable. If
Yeah.
that total sum exceeds $13,610,000 for 2024,
13.61 million. That's the magic number for 24.
that's the number. If the total exceeds that, then your estate generally needs to file Form 706. If the combined value of these assets is below this amount, filing is generally not required, unless the estate is making a specific election, like portability.
Portability. We'll definitely get to that. Sounds important for tax saving.
Very much so. It's a powerful strategy, especially for married couples.
And the timeline for filing this, is it something that needs to be done, immediately after someone passes, or is there a bit more breathing room?
The federal estate tax return is typically due within 9 months of the date of the decedent's death.
9 months. Okay.
This period can sometimes be extended for up to 6 months, but that's the general deadline that executors must meet. Meeting this deadline is critical not just for compliance, but also because many of the key tax-saving elections we'll discuss require a timely filed return to be valid. Miss the deadline, you might miss the strategy.
Wow. Okay, so understanding these basics truly is the first step in unlocking the ways to reduce that tax burden. It feels like getting the rules of the game down before you can actually play. And now, this is where it gets really interesting. The powerful strategies built right into the system, designed to save money and maximize what you pass on. Let's talk about the big numbers first.
Yeah.
What's the fundamental amount that can pass tax-free before any of these calculations or strategic moves even begin? This seems like where many individuals and couples start to see the immediate potential for significant estate tax savings.
That's the basic exclusion amount, and it is indeed the cornerstone of federal estate tax planning. For 2024, this amount is, as we said, $13,610,000.
Okay.
This figure is dynamically adjusted annually for inflation, meaning it generally increases year over year.
So it keeps pace, roughly.
Right. And this basic exclusion is profoundly significant because, as we just discussed, if an estate's gross value, combined with those adjusted taxable gifts, falls below this specific amount, it generally isn't required to file Form 706 at all.
Meaning no federal estate tax.
Correct. For the vast majority of estates, there will be no federal estate tax liability to worry about because of this high exclusion amount.
So for most people listening, this number means federal estate tax is simply not a concern right now. But for those with larger estates, this exclusion is the critical starting point for reducing the tax burden. And for married couples, there's a particularly clever way to double down on this exclusion, right? The deceased spousal unused exclusion, or DSUE, and portability. This sounds like a real game changer for couples who are proactively planning their estates.
It absolutely is, and it's arguably one of the most powerful tax-saving provisions in estate planning for married individuals. DSUE portability allows a surviving spouse to essentially inherit any unused portion of their deceased spouse's federal estate tax exclusion amount.
Inherit the exclusion. How does that work?
Well, here's how it works. If a decedent spouse passed away after 2010, that's a key date, and their estate didn't use all of its applicable exclusion against their gift or estate tax liability.
So, say the first spouse to die had a smaller estate, well below the limit.
Exactly. Then that unused amount, the DSUE, can be transferred and made available for use by the surviving spouse's estate. They can use it either for lifetime gifts or add it to their own exclusion at their death.
So effectively, it's like combining your individual exclusion amounts, giving you a much larger shield against estate tax. This is crucial for larger estates, as it means a couple can potentially transfer over $27 million tax-free in 2024.
That's the math, yes. Over $27 million combined.
How does an estate actually make this election? Is it automatic, or does it require a specific step? Because missing this sounds like a huge mistake.
It is not automatic, and this is where proactive planning and meticulous compliance become essential. The election for portability is made by timely filing a complete Form 706 for the first deceased spouse.
Even if that first spouse's estate is below the filing threshold.
Yes, that's the key point. Even if an estate wouldn't ordinarily be required to file a Form 706 because its gross estate is below the $13.61 million threshold, it might choose to file one solely to elect portability and preserve that DSUE amount for the surviving spouse.
Ah, okay. So filing might be strategic, even if no tax is due.
Precisely. The benefit is substantial. It allows the surviving spouse to add the DSUE amount to their own basic exclusion, potentially significantly increasing the total amount of wealth that can pass free of federal estate tax. This is a crucial tax-saving method, as it effectively doubles the exclusion for many married couples, provided the proper election is made. Missing this step could literally cost an estate millions in future tax.
That's a huge strategic advantage, especially for couples who have built up significant wealth together. But with such a powerful benefit, I imagine the IRS isn't just taking everyone's word for it. What kind of safeguards or verification steps are in place regarding this DSUE amount?
Yes, there are checks and balances. When a surviving spouse eventually applies that DSUE amount, either to lifetime gifts or to their own estate at death, the IRS reserves the right to examine the predeceased spouse's return to verify the allowable DSUE amount.
So they can look back at the first return filed potentially years later?
Exactly. This means accuracy in the initial filing for portability is paramount, as the DSUE amount can be adjusted or even eliminated if errors are found during a later audit. This underscores why attention to detail on Form 706, even for a non-taxable estate, is so important if you're electing portability.
Right. Get it right the first time.
Absolutely. The DSUE amount is meticulously calculated in Part 6, Section C of Form 706. And there's a nuance if assets are transferred to a qualified domestic trust, or QDOT.
Oh, QDOT. What's that?
That's used when the surviving spouse is not a U.S. citizen. We'll touch on that more with the marital deduction. But in that case, the DSUE amount calculated initially is considered preliminary and will be redetermined later, ensuring careful tracking of those specific assets.
Okay, makes sense. And there's even a way to restore some exclusion for certain historical situations involving same-sex spouses. That's a niche but important detail for those specific families.
That's correct. Line 9C on Form 706 addresses what's called the restored exclusion amount. If a decedent made a taxable gift to their same-sex spouse during their lifetime, and due to prior legal restrictions on recognizing same-sex marriage.
Before the Obergefell decision, maybe?
Exactly. If that transfer inadvertently reduced their applicable exclusion amount back then, the amount of that reduced exclusion can now be restored.
So correcting a past inequity based on evolving law.
Precisely. This provision highlights the IRS's adaptation to evolving legal contexts and provides a specific tax benefit for individuals who are impacted by previous limitations on marital recognition. It's a key example of how tax law can evolve to address fairness in different circumstances.
Okay, that covers the big exclusions. Beyond these foundational exclusions, the tax code allows for significant deductions. This is where we can really start to chip away at the taxable estate, effectively reducing the base upon which the estate tax is calculated. Let's dig into arguably the biggest one, the marital deduction. This seems like a massive opportunity for tax savings for married couples.
Absolutely. The marital deduction is perhaps the most powerful tool for reducing or really deferring estate taxes for married individuals. The core principle is remarkably straightforward. Property passing from the decedent to their surviving spouse can often be fully and without limit deducted from the gross estate.
Fully deducted. Unlimited.
Generally, yes, unlimited. This leads to substantial estate tax savings, or at the very least, it defers the payment of the federal estate tax until the death of the surviving spouse. It's a mechanism that effectively allows a married couple to pass an unlimited amount of wealth between them without triggering immediate federal estate tax upon the first death.
So in a sense, a married couple can almost pass an unlimited amount of wealth between them without triggering immediate estate tax. That sounds incredibly flexible. Who is eligible for this? Is it only for property transferred directly through a will, or are there other avenues?
The eligibility is quite broad. It applies to property the surviving spouse receives in many forms. As a direct recipient under a will or trust that's a legatee or divisé as an heir, if there's no will, as a done of a gift that transfers at death as a surviving joint tenant.
Like on a joint bank account or house.
Exactly. Or as an appointee under a power of appointment, as a beneficiary of life insurance, or even through spousal rights like dower or courtesy, which are older concepts but still exist in some places. The key is that the property must actually pass to the surviving spouse, and crucially, they must generally have complete control over it, or it must meet specific exceptions.
Okay, control is key. But you mentioned exceptions.
Yes, because there are complexities. The tax code specifies what are called non-deductible terminable interests.
Terminable interests, meaning they end.
Right. These are interests that will terminate or fail after a period of time or upon the occurrence or non-occurrence of some event. For example, if you give your spouse a life estate in a property, meaning they can live there and use it for their life but can't sell it or pass it on to their own heirs that generally wouldn't qualify for the marital deduction because their interest is temporary, it terminates at their death.
So if your spouse only gets a temporary right to an asset, that doesn't qualify for the deduction. That seems counterintuitive if the goal is to provide for the spouse while deferring tax. Is there a way around that? Because a lot of people might want to do that.
That's precisely where a critical exception comes in, known as the Qualified Terminable Interest Property, or QTIP, election.
QTIP.
This election allows otherwise non-deductible terminable interests, like that life estate we just talked about, to qualify for the marital deduction. It's incredibly useful because it lets the deceased person provide for their surviving spouse, typically by giving them an income interest for life from a trust, while still controlling the ultimate disposition of the assets after the spouse's death.
So the first spouse still gets to say where the property goes eventually.
Exactly. This is a common strategy in second marriage situations, for instance, where someone wants to provide for their current spouse but ensure assets ultimately pass to children from a prior marriage.
That makes a lot of sense. Provides for the spouse, protects the kid's inheritance.
It's a strategic balance, and it's important to note that for certain joint and survivor annuities, the QTIP election is actually automatic, unless the executor actively elects out, simplifying things in those specific cases.
Okay, that QTIP election sounds really flexible for complex families. But what about situations where the surviving spouse isn't a U.S. citizen? You mentioned QDOTs earlier. Does the marital deduction still apply then, or are there special rules?
That's where qualified domestic trusts, or QDOTs, become absolutely essential. If the surviving spouse is not a U.S. citizen, property transferred to them generally won't qualify for the marital deduction unless it's placed in a QDOT.
Why the special rule?
The concern is that a non-citizen spouse might leave the U.S. with the assets, potentially avoiding U.S. estate tax altogether upon their later death. The primary purpose of a QDOT is to ensure that the estate tax on the transferred property is deferred, not eliminated. The tax becomes due when property is distributed from the trust during the spouse's lifetime or upon the death of the non-citizen surviving spouse.
So it keeps the assets kind of tethered to the U.S. tax system.
In a way, yes. To qualify, the trust must meet specific requirements. At least one trustee must be a U.S. citizen or a domestic corporation, and the trust instrument must specifically require that no principal distributions can be made without tax withholding, essentially. The executor must also make a formal QDOT election on the estate tax return. So it effectively defers the estate tax until the property leaves the QDOT, ensuring the tax eventually gets paid while still providing for the non-citizen spouse.
That's a vital deferral mechanism, avoiding immediate taxation while setting the stage for future compliance. What about those who wish to leave a legacy to good causes, like charities or nonprofits? Is there a deduction for that, and how significant can it be?
Absolutely. The charitable deduction, which is reported on Schedule O of Form 706, is another incredibly significant tax-saving provision. Amounts transferred to qualifying charities are fully deductible from the gross estate dollar for dollar.
Dollar for dollar. Wow.
Yes. This directly reduces the taxable estate and, consequently, the estate tax liability. There's no limit to how much can be deducted for qualifying charitable bequests, meaning a substantial charitable gift can dramatically lower or even eliminate estate tax altogether.
Okay, that's powerful. Which organizations qualify? Are we talking about any charity, or does the IRS have specific types in mind? I imagine the rules are pretty strict here.
They are quite specific, yes, to prevent abuse. It applies to transfers to U.S. government entities for exclusively public purposes, qualifying religious, charitable, scientific, literary, or educational organizations.
The typical 501c types.
Generally, yes. Also, veterans organizations and even employee stock ownership plans under specific, very narrow conditions. The key is that no part of the net earnings of the organization benefits any private individual, and there are strict rules against substantial lobbying or political campaign activities. So it's about genuine public benefit aligned with IRS definitions.
Got it. So it's about genuine public benefit. What if someone passes away and a beneficiary, maybe a child for whatever reason, decides they don't want the inheritance, and under the will or state law, it then goes to a charity instead? Does that still count for the deduction?
Yes, it can, and this is where a qualified disclaimer comes into play as a strategic post-mortem planning tool.
A disclaimer?
Yeah.
Like saying no thanks?
Essentially, yes. If a beneficiary refuses to accept an interest in property through a qualified disclaimer that meets specific legal conditions, it has to be in writing within a certain time frame, etc., and as a result that property passes to a qualified charity, then it can indeed qualify for the charitable deduction for the estate.
So the family can effectively redirect assets to charity after death and get the tax benefit.
Exactly. It provides a valuable opportunity for families to optimize the estate's tax situation even after death. However, there's a catch. The deduction is always limited to the amount actually available for charitable uses. This means it must be reduced by any federal estate tax, GST tax, or other death taxes that might be payable from that specific charitable bequest itself.
Okay, so it's not always the face value of the gift if taxes have to be paid out of that gift first.
Precisely. If the will says taxes come out of the charitable share, the deduction is reduced accordingly.
That's a crucial point. Beyond bequests and gifts, what about the actual costs of wrapping up an estate? Funeral costs, legal fees, executor fees. Can those expenses actually reduce the taxable amount? That seems like a very practical way to chip away at the total.
Yes, they absolutely can, and these are vital deductions that often get overlooked but are critical for reducing the taxable estate. We're talking about funeral and administration expenses, reported on Schedule J, and deaths of the decedent, reported on Schedule K.
Okay, Schedule J and K. What's covered under funeral expenses?
Things like burial costs, cremation, funeral services, embalming, even the cost of a reasonable headstone or monument are generally deductible. However, any reimbursements the estate receives from sources like the Social Security Administration lump sum death benefit or Veterans Administration burial benefits must reduce the deductible amount. So it's the net cost to the estate that counts.
Makes sense. And what about the ongoing costs associated with managing the estate itself, from the moment someone passes until everything is settled and distributed? Legal fees, accounting, etc.
Right. Those fall under administration expenses, and several categories are deductible. Executors' commissions are deductible if they've been paid or are reasonably expected to be paid, and importantly, if they fall within the limits allowed by local law or the decedent's will.
But those commissions are income to the executor, right?
Correct. It's a deduction for the estate, but taxable income to the executor personally. Similarly, attorney fees incurred for the administration of the estate, for example, for probating the will, advising the executor on their duties, handling tax matters, litigation are deductible if paid or reasonably expected, provided they are reasonable and allowable under local law.
And miscellaneous costs, like getting appraisals.
Exactly. Miscellaneous expenses, such as appraisal fees for valuing estate assets, which we'll talk more about, accounting fees for preparing tax returns or estate accountings, court costs, storage fees, insurance premiums necessary to preserve estate property, basically. Costs necessarily incurred in preserving and distributing the estate are also deductible.
Okay, seems pretty comprehensive. And what about interest on taxes? Say, if there's a delay in payment of the estate tax itself, can that reduce the taxable estate?
Interest expenses incurred after the decedent's death can generally be deducted if they are reasonable, necessary for the estate's administration, and allowable under local law. For example, interest paid on a federal estate tax deficiency or interest on state death taxes can often be deducted as an administrative expense on Schedule J.
So interest paid to the government can sometimes be deducted from the amount owed.
In a way, yes, it reduces the taxable estate. However, and this is a crucial caveat we touched on earlier, if you elect to pay the estate tax in installments under Section 6166, that special rule for closely held businesses.
Right, the deferral plan.
Yes. The interest payable on those installment payments is specifically not deductible as an administrative expense for estate tax purposes. That's a big difference.
That's a very important distinction. Definitely impacts the cost benefit of that election. And regarding debts the person had before they passed, mortgages, credit cards, loans, how does that factor in?
Yeah.
Are all outstanding debts deductible on Schedule K?
Valid debts owed by the decedent at the time of death are deductible. This includes things like mortgages on property included in the gross estate, though usually only the decedent's share if jointly owned, outstanding personal loans or promissory notes, unsecured debts like credit card balances, unpaid utility bills accrued before death, property taxes that had accrued before death but weren't yet paid, and even federal or state income taxes owed on the decedent's lifetime income up to the date of death.
Okay. What about medical expenses from their final illness?
That's a key point. Medical expenses incurred by the decedent but unpaid at death can be deducted either on the estate tax return, Schedule K, as a claim against the estate, or the executor can elect to deduct them on the decedent's final individual income tax return, Form 1040.
You have a choice.
Yes, but you can't deduct them on both returns. This requires a strategic choice based on where the deduction provides the greater overall tax benefit, considering both the estate tax rate and the decedent's final income tax situation.
Another planning opportunity there.
Definitely. Also, it's vital to understand another crucial caveat related to administration expenses versus income tax deductions. Expenses incurred in administering property subject to claims, basically, the probate estate cannot generally be deducted on both the estate tax return, Form 706, and the estate's fiduciary income tax return, Form 1041.
So another choice, deduct legal fees on 706 or 1041.
Generally, yes, you pick one. There's an exception for certain deductions in respect of a decedent, like taxes, intra and business expenses that had accrued at the time of death. Those can sometimes be deducted on both, but things like executor commissions and attorney fees, you typically choose. Funeral expenses, specifically, are only deductible on the estate tax return and can never be claimed on an income tax return.
Okay, lots of rules about where to take the deduction. It really highlights the need for careful accounting and planning by the executor.
It absolutely does. These choices can significantly impact the total tax paid by the estate and its beneficiaries. Professional advice is often invaluable here.
That's quite a nuanced decision point. And some states have their own death taxes, right? like inheritance taxes or estate taxes, on top of the federal one. Can paying those state taxes actually help reduce the federal liability?
Yes, they can, and this is another valuable deduction, though it's structured a bit differently. Form 706 allows for a deduction on line 3B of Part 2 for state death taxes. This includes estate, inheritance, legacy, or succession taxes actually paid to any state or the District of Columbia on property that's included in the federal gross estate.
So if you pay state estate tax, you get a federal deduction for it.
Correct. You can even claim an anticipated amount of this deduction when you initially file the federal return, but the final allowance of the deduction requires proof of actual payment of those state death taxes. And you generally must claim this deduction within 4 years after the federal return is filed, or potentially within an extended period under specific circumstances, like if you're contesting the state tax.
Is there a limit on how much state tax you can deduct?
What's particularly noteworthy about this deduction, unlike the old state death tax credit that used to exist, is that the deduction is not subject to dollar limits. Whatever the allowable state death tax actually paid is, it's fully deductible from the federal gross estate, providing further relief from the federal estate tax burden.
No limit. Wow. That's a significant help, especially for states with high state death taxes.
It really can be, yes.
Yeah.
It directly reduces the federal taxable estate.
Okay, we've now explored how to use exclusions and deductions to dramatically reduce the size of the taxable estate. It's huge. But beyond deductions for what you own or expenses you incur, there are powerful ways to potentially reduce the value of the assets themselves for tax purposes. This sounds like it could be a massive tax saver, especially if assets have fluctuated in value after death. Let's talk about alternate valuation first.
Alternate valuation, yes. This is a choice, an election, available to the executor under Section 2032 of the Tax Code. It allows the estate to value all property included in the gross estate as of 6 months after the date of the decedent's death, instead of valuing everything at the date of death itself.
6 months later, why would you want to do that?
Well, this can be incredibly beneficial for tax-saving purposes, particularly if asset values have declined significantly in the 6 months following the decedent's death. Think about a volatile stock market or maybe a real estate market downturn.
So if the estate's value drops, you can use the lower value.
Potentially, yes. But there's a strict dual condition for making this election. It can only be made if choosing alternate valuation results in both a reduction of the gross estate and a reduction of the net estate tax liability due after credits.
Both have to happen.
Yeah.
So you can't elect it just because values went down if the estate wasn't going to owe tax anyway.
Exactly. If the estate already owes no tax, maybe due to the large basic exclusion or deductions like the marital deduction, you can't elect alternate valuation even if values dropped. It also means you can't elect it if, somehow, asset values went up, but it resulted in a lower tax due to some interaction with credits or deductions that's not allowed either. It must decrease both the gross estate and the tax due.
Okay, so it's purely a tax-saving mechanism for situations where asset values fall and tax is actually owed. And you can't just pick and choose which assets you want to value later, right? Like, use the lower stock value, but the higher house value.
That's absolutely correct. It's an all-or-nothing deal. There is no partial election. It applies to all property included in the gross estate. You value everything as of the alternate date, or the date of disposition if sold or distributed within the 6 months. You can't value some assets at death and others at the alternate date.
All or nothing. What exactly gets valued at that 6-month mark?
The property included in the alternate valuation is generally the property that was part of the gross estate at the decedent's death. Now, income earned after death, like interest accruing after death on a bond or rent collected after death, is generally not included in the alternate value. However, things that were effectively part of the value at death but might be received later, like interest accrued up to the date of death, rent accrued up to death, or outstanding dividends declared to stockholders of record on or before the date of death, are included in the alternate valuation. Ordinary dividends declared after death are generally not included.
Okay, that distinction between pre-death accruals and post-death income is important. Can you give us a real-world example of how this alternate valuation choice would play out and where it provides the most benefit?
Certainly. Let's use your volatile stock example. Imagine a decedent passed away on January 1st, 2024, owning a portfolio of tech stocks valued at, say, $2 million at the date of death. The estate is large enough that it will owe federal estate tax. Due to a sharp market correction, by July 1st, 2024, exactly 6 months after death, That same portfolio is now only valued at $1,500,000.
A significant drop.
Right. If the executor elects alternate valuation, the estate can value the stock portfolio at $1,500,000 instead of $2 million. Assuming other assets didn't drastically increase, this significantly reduces the gross estate by $500,000 and consequently the estate tax liability. Depending on the tax bracket, this could translate to $200,000 or more in actual tax saving.
Wow, that's huge. What if they sold some stock before the 6 months was up?
Good question. If any property is distributed, sold, exchanged, or otherwise disposed of within the 6-month period after death, it's valued as of the date of that disposition, not the 6-month mark. So if a portion of that stock had been sold on May 1st, 2024, its value on May 1st would be used for alternate valuation purposes.
So you have to track those dates carefully within the 6 months.
Absolutely. The executor needs meticulous records. Alternate valuation is a critical strategy when asset values might decline after death, providing a vital safety net against paying tax on value that no longer exists by the time the tax is effectively paid.
That's a very clear illustration of how impactful this choice can be. Now, let's pivot to something more specialized, but incredibly significant for certain estates. Special use valuation under Section 2022A. This sounds like it could provide substantial relief for families involved in farming or closely held businesses, maybe helping them avoid having to sell the family enterprise just to pay taxes.
It truly can, and it's another powerful, though complex, tax-saving strategy. This specific provision allows certain qualifying farm or closely held business real property to be valued based on its actual use, for example, as active farmland or for a specific business operation, rather than its highest and best use.
Highest and best use, like what it could be sold for.
Exactly. Imagine farmland on the edge of a growing city. Its highest and best use might be for residential development, making its market value very high, but its value purely as farmland might be significantly lower. Special use valuation lets the estate use that lower actual use value for estate tax purposes.
So valuing it based on its productive use rather than its speculative market value.
Precisely. This can result in a significantly lower taxable value, directly reducing the estate tax burden. For families trying to maintain a multi-generational farm or business, this can be the difference between keeping the operation going and being forced to sell the land or liquidate the business just to pay the estate tax.
That could make a massive difference. What are the key eligibility conditions for this? Because it sounds like it can't be just any property or any business. The requirements must be strict.
You're right, the conditions are quite stringent, reflecting the targeted nature of this relief. They are crucial for qualifying. First, the decedent must have been a U.S. citizen or resident, and the real property must be located in the United States. That's basic. Second, for at least 5 of the 8 years immediately preceding the decedent's death, the real property must have been owned by the decedent or a family member and used for a qualified purpose like farming or another trade or business. And there must have been material participation by the decedent or a family member in the operation of that farm or business during that time.
5 out of the last 8 years. Used and actively participated in.
Correct. Or, alternatively, it could have been rented for such qualified use by the surviving spouse or a lineal descendant of the decedent to a member of the decedent's family on a net cash basis. That's a specific allowance. Third, the real property must have been acquired from or passed from the decedent to a qualified heir.
Qualified heir. Who counts?
A qualified heir is specifically defined. It includes the decedent's ancestor, their spouse, a lineal descendant of the decedent, like children, grandchildren, including legally adopted children and stepchildren, a lineal descendant of the decedent's spouse, a lineal descendant of the decedent's parents, or the spouse or surviving spouse of any such lineal descendant. It's a defined family group.
So it has to stay within that family circle.
Essentially, yes, to qualify for the initial valuation benefit. Fourth, we already mentioned material participation for 5 of the 8 years before death. This is a key test. And finally, there are significant percentage requirements that demonstrate the farm or business is a major part of the estate.
Percentage requirements.
Yes. At least 50% of the adjusted value of the gross estate must consist of the adjusted value of qualified farm or business property, both real and personal property, and at least 25% of the adjusted value of the gross estate must consist of the adjusted value of qualified real property.
50% total, 25% real property.
Okay, those thresholds ensure it's really a farm or business estate.
Exactly. Meeting these percentage tests is critical for eligibility.
You mentioned material participation a couple times. What exactly does that mean in this context? Is it just owning the land, or do they have to be actively involved in the day-to-day operations? Driving the tractor, so to speak. Well, maybe not driving the tractor specifically, but it's definitely more than just passive ownership. Material participation is a factual determination based on all the circumstances. It generally means being actively involved in making management decisions that affect the success of the business, or physically working on the farm or in the business. Simply collecting rents, salaries, or dividends, or merely approving capital expenditures or broad farm plans is usually not enough.
So hands-on involvement.
Yes. Think regular consultation on operations, inspecting production, advancing funds, and assuming financial responsibility, making substantial management decisions. However, there are special, slightly relaxed rules for surviving spouses. They only need to meet an active management standard, which might involve less day-to-day involvement. There are also specific provisions that help decedents who are retired and receiving Social Security benefits or were disabled before death meet the test by looking at earlier periods.
Okay, so it's about meaningful involvement, but with some flexibility for certain situations.
Yeah.
If an estate qualifies, how is the value actually determined under the special rule? Is it just an arbitrary lower number, or is there a specific method?
No, it's not arbitrary. It's based on specific valuation methods designed to reflect the property's use value, not its speculative market value. For farming purposes, the primary method is the farm method, or annual gross cash rental method.
Cash rental method.
Yes. It involves finding the average annual gross cash rental for comparable farmland in the same locality used for farming purposes. Then you subtract the average annual estate and local real estate taxes on that comparable land. The result is then divided by the average annual effective interest rate charged for all new federal land bank loans. These averages are typically based on the 5 most recent calendar years ending before the decedent's death.
Wow, that's specific. A formula based on local rents, taxes, and interest rates.
Exactly. It aims to derive a value based on the land's earning capacity as a farm. If comparable cash rentals aren't available, or for valuing closely held business real property, alternative methods are used, often involving capitalizing the income the property is expected to generate from its qualified use.
So it's quite a precise calculation designed to give a fair use-based value. And if an estate qualifies and uses this special valuation, is that the end of it? Is it set in stone, or are there any conditions that could cause issues later, perhaps requiring the estate to pay back some of those tax savings? Because that sounds like a big potential benefit.
There is indeed a significant potential downside, a string attached. If the qualified use of the property ceases, or if the property is disposed of to someone who is not a member of the qualified heir's family, within a specified period, generally 10 years after the decedent's death, a recapture tax can be imposed.
Recapture tax, you mean they have to pay the tax they saved?
Essentially, yes. The estate, or rather the qualified heir who received the property, may have to pay back some or all of the estate tax savings that resulted from using special use valuation, plus interest. This recapture mechanism ensures that the tax benefit is only granted when the property truly continues in its qualified use by the family for a substantial period.
So the family has to keep farming it or running the business for 10 years, basically.
That's the general idea. There are nuances, but that's the core requirement to avoid recapture. The election itself is made formally by checking yes on Form 706, Part 3, Line 2, and critically completing and attaching Schedule A1, which requires detailed information, appraisals, and a written agreement signed by all parties having an interest in the property, consenting to personal liability for any potential recapture tax.
So it's a powerful tool, but comes with significant ongoing compliance requirements and potential liability for the heirs. Definitely need to go in with eyes wide open.
Absolutely. It's not an election to be made lightly, but for the right situation, the tax savings can be crucial for preserving a family legacy.
We've covered a lot about reducing the amount of tax, which is fantastic and offers incredible savings potential through exclusions, deductions, and valuation choices. But even if you've done everything possible to minimize the tax bill, there still might be a payment due. And that payment can be substantial, often requiring significant liquidity that an estate, especially one with a business or farm, might not have readily available. But the IRS provides ways to avoid a, fire sale of assets just to pay the bill, especially for businesses. This next part is about managing when and how it's paid, rather than just how much.
You've hit on a critical point for liquidity planning and preserving business continuity. Section 6166 of the Internal Revenue Code provides a very important relief provision. It allows an estate with a qualifying interest in a closely held business to defer payment of a portion of the federal estate tax attributable to that business interest.
Defer payment. For how long?
The estate can defer the tax payment for up to 5 years from the original due date of the return, paying only interest during that time. Then, after the deferral period, the estate can pay the tax in up to 10 equal annual installments.
So potentially up to 13 years total to pay the tax related to the business. 5 years deferral plus first installment at year 5 plus 9 more installments.
That's right, up to 14 years from the original due date. This is a liquidity saving mechanism, not a tax reducing one, but it's absolutely vital for preserving family businesses or farms that might otherwise be forced into selling assets, maybe even the business itself, just to cover immediate tax obligations. It allows the business time to generate income to meet those tax obligations over a much longer period.
That's a huge relief for families trying to keep a business intact without being forced to liquidate key assets. What are the specific criteria for an estate to qualify for this installment payment plan? You mentioned a qualifying interest.
Yes, the primary requirement relates to the significance of the business within the estate. To be eligible for Section 6166 deferral, the value of the interest in the closely held business that is included in the decedent's gross estate must be more than 35% of the adjusted gross estate.
More than 35%. That's a substantial chunk of the estate. What's the adjusted gross estate for this purpose?
The adjusted gross estate is specifically defined for Section 6166. It's essentially the gross estate less certain deductions allowable under Sections 2053 and 2054, basically. Funeral expenses, administration expenses, claims against the estate, mortgages, and casualty losses.
Okay, so gross estate minus those key deductions. If the business value clears that 35% hurdle, the executor can elect to pay the portion of the estate tax attributable only to that business in installments, right? Not the whole tax bill.
Correct. It's only the tax attributable to the qualifying closely held business interest that can be deferred and paid in installments. The portion of the tax attributable to other assets in the estate is still due at the regular 9-month deadline, unless an extension for payment is granted for reasonable cause, which is a separate process.
Got it. So it's a high bar, 35%, designed for estates where the business truly represents the bulk of the value and immediate payment would cause undue hardship. What are the practical details of these payments? Does the interest on the deferred tax also get deferred, or does that still need to be paid currently?
No, the interest on the unpaid portion of the tax is not deferred. It must be paid annually, even during the initial 5-year deferral period. Only the tax principal is deferred.
So interest payments start right away.
Yes, and there's actually a special favorable interest rate that applies to the tax deferred on the first $1 million or so of business value, indexed for inflation. But the regular underpayment rate applies to the deferred tax above that amount. It's important for estates to stay meticulously on top of all payments, both interest and the later principal installments, because if any payment is missed by 6 months or more, the IRS can terminate the right to make installment payments and demand acceleration, meaning the entire remaining tax balance becomes due immediately.
Ouch. So missing a payment has serious consequences.
Very serious. To provide security for these deferred payments, especially given the long time frame, the IRS may require the estate to post a surety bond. Or, as an alternative, the executor can elect a special lien under Section 6324A, which places a lien on specific estate property equal in value to the deferred tax amount plus the required interest amount for the first 4 years of deferral.
A lien on property instead of a bond.
Right. This often avoids the cost and difficulty of obtaining a commercial surety bond, but it does encumber the property subject to the lien.
Okay, Section 616C is a powerful tool for managing liquidity for business owners, but with clear responsibilities and potential pitfalls if payments aren't handled meticulously. And there's another specific, albeit maybe more niche, payment deferral option for certain future interests, right? Section 6163.
Yes, that's correct. Section 6163 provides for the postponement of tax attributable to what are called reversionary or remainder interests included in the gross estate.
Reversionary or remainder interests, like getting property back after someone else's life estate ends.
Exactly. If the estate includes the value of an interest where the actual possession or enjoyment is deferred until sometime in the future, typically after an intervening interest, like a life estate, terminates, Section 6163 allows the executor to elect to postpone payment of the portion of the estate tax related to that future interest. The deferral lasts until 6 months after the preceding interest terminates.
So you don't pay the tax until the estate actually gets the property.
That's the idea. This deferral period can also be extended for reasonable cause for up to an additional 3 years. It's a more specialized provision, but very helpful when an estate includes valuable future interests that aren't currently generating income or available to pay the tax.
Got it. Okay, so these deferral options provide crucial breathing room for paying the tax. Now, we've talked about all these fantastic strategies, exclusions, deductions, valuation, deferrals. They sound incredibly beneficial on paper, but knowing the rules is only half the battle, isn't it? Proper execution, getting the paperwork right, seems absolutely key. What are some critical compliance aspects that executors and families need to be aware of to ensure these hard-won benefits aren't lost through procedural errors or oversights?
This is precisely where meticulous attention to detail becomes paramount. You can have the best strategy in the world, but if you don't comply with the procedural requirements, you can lose the benefit or face penalties. It's critical.
So what are some key things to watch out for? Let's start with just signing the return.
Right. First, on signature and verification. If there's more than one executor appointed for the estate, all listed executors are jointly responsible for the return and any tax due, even if only one physically signs the return under penalties of perjury. That shared responsibility is important. Paid preparers also have specific signing and furnishing requirements and are subject to their own set of penalties if they take unreasonable positions or engage in willful or reckless conduct. This underscores the importance of accuracy and due diligence by everyone involved.
Okay, shared responsibility for executors. What if something needs to be corrected after the return has already been filed? It's a complex form, over 30 pages with schedules. Mistakes must happen sometimes.
They do. If you discover an error or need to provide additional information after the Form 706 has been filed, you should file an amended return. You do this using a new current Form 706, clearly marking the amended checkbox at the top of page 1 and attaching an explanation of the changes. This allows for corrections and, if done properly and timely, might mitigate or avoid penalties that could otherwise apply.
Good to know there's a process for fixing things. Speaking of penalties, what kind of trouble can an estate get into if things aren't done right?
Well, the penalties can be quite stiff, unfortunately. There are significant penalties for valuation understatements. If property is reported on the return at a value that's 65% or less of the amount determined to be correct, a 20% accuracy-related penalty on the resulting underpayment can apply.
20% penalty just for undervaluing assets.
Yes, if it meets that threshold. And it gets worse. If there is a gross valuation understatement, meaning property is valued at 40% or less of the correct value, the penalty jumps to 40% of the underpayment.
40%, wow, that's a huge hit.
It is. There are also penalties for late filing of the return and late payment of the tax, unless the failure is due to reasonable cause and not willful neglect. Penalties can also apply for underpayment of GST taxes, and as mentioned, return preparers face penalties too. This really emphasizes the critical importance of accuracy, especially in valuations, and timeliness in all aspects of estate tax filings.
Absolutely. It's not just about getting the deduction amounts right, but also about having solid support for the underlying valuation of all the assets reported. And I've heard about something called consistent basis reporting. What's that about, and how does it affect the beneficiaries who inherit the property?
Consistent basis reporting, yes. This primarily involves Form 8971, information regarding beneficiaries acquiring property from a decedent, and its accompanying Schedule A. This is a relatively newer requirement stemming from legislation enacted in 2015, and it's crucial for transparency between the estate and its beneficiaries, and ultimately for the IRS.
What does it require?
Certain estates, generally those required to file a Form 706, must now report the final estate tax value of assets passing to beneficiaries to the IRS on Form 8971 and provide a Schedule A to each beneficiary showing the final estate tax value of the specific property they inherited.
So the beneficiary gets official notice of the value used for estate tax.
Exactly. The primary goal here is to ensure consistency. The beneficiary's initial basis in the inherited asset, which is critical for calculating their capital gains or losses when they eventually sell it, must generally be consistent with the value reported on the estate tax return.
Ah, so it prevents the estate from using a low value to save estate taxes, and then the beneficiary trying to use a high value later to save income taxes when they sell.
Precisely. It closes that potential loophole or whipsaw effect. The rule is that the beneficiary's basis cannot exceed the value finally determined for estate tax purposes. Failure by the executor to file Form 8971 or provide the Schedule A to beneficiaries when required can lead to significant information return penalties. This is a key compliance step that empowers beneficiaries with accurate basis information for their own future tax planning and ensures consistency across the tax system.
That makes perfect sense for preventing tax games and ensuring fairness. Okay, so the return is filed, maybe amended, basis is reported.
Yeah.
How do executors get final closure? How do they confirm that the IRS has reviewed everything and closed the estate's tax liability? Is there a formal letter or something they receive?
That's a great practical question. Historically, the IRS would automatically issue an estate tax closing letter, often called an ETCL, once it had processed and accepted the Form 706 or completed an audit. This letter was the formal confirmation that the federal estate tax liability was settled.
Okay, so you'd get a letter.
Well, that's changed. ETCLs are no longer automatically issued for all estates. Executors now generally need to proactively request an ETCL. This is typically done through the pay.gov website, and there's currently a user fee. I think it's around $67 for this service.
You have to ask for it and pay for it.
Yes, and it's generally recommended to wait at least 9 months after filing the Form 706 before making the request to allow adequate processing time by the IRS.
What if you don't want to pay or just need confirmation faster? Is there an alternative?
Yes, as an alternative to a formal ETCL, executors or their authorized representatives, like an attorney or CPA with a power of attorney, can request an account transcript for the estate. Transcripts are free and often available much quicker. An account transcript reflects transactions posted to the estate's account, including the acceptance of the Form 706 as filed or the completion date of an examination, which can serve a similar purpose in confirming closure. These transcripts can be requested online through IRS systems available to registered tax professionals or by submitting Form 4506T.
Okay, so transcript is a faster, free alternative, but the ETCL is the formal letter.
Correct. Obtaining either the transcript showing completion or the formal ETCL is crucial for executors. It provides peace of mind and is often required by third parties like banks or title companies before they will release funds or clear title to assets, allowing for the final distribution of the estate.
Right, you need that proof to finally wrap things up. And finally, just on the paperwork itself, getting the Form 706 submitted correctly, are there common pitfalls or basic mistakes people make when actually filling out and filing the return, even if they're trying to be diligent?
Yes, absolutely. A critical compliance point, often overlooked, maybe because it seems basic, is simply filing all required schedules and filling them out completely.
All required schedules.
Yes, you must file the first 4 pages of Form 706, which contain the core information and computations. But you also must attach all the schedules that are relevant to the estate's assets and deductions. Schedule A for real estate, Schedule B for stocks and bonds, Schedule C for mortgages and notes, Schedule F for other miscellaneous property, Schedule M for the marital deduction, Schedule O for charitable gifts, Schedules J, K, L for expenses, debts, and losses, and so on.
Even if a schedule has nothing on it.
Well, if a schedule is entirely inapplicable, you might not need to attach it. But if it is applicable, even if the amounts are 0 for certain lines, you need to complete it properly. The Form 706 instructions explicitly state that returns filed without entries in each required field will not be considered complete and will not be processed. They might be returned to you. This means every relevant section must be filled out appropriately. Use 0, none, or NA where applicable, but don't just leave required lines blank. This ensures the return is accepted for processing and avoids unnecessary delays or correspondence with the IRS asking for missing information.
Fill in all the blanks. Sounds simple, but easy to miss on such a long form. Okay, one last area. What if there are significant expenses or potential deductions that are still uncertain or being contested at the time the Form 706 is due? Like maybe there's ongoing litigation against the estate or a complex claim that hasn't been resolved. Can you still potentially get a deduction for those items, or do you lose out if they aren't finalized before the filing deadline?
That's an excellent question, and it addresses a common practical problem. The answer is yes, there's a specific mechanism to handle this. Protective claims for refund, filed using Schedule PC. protective claim for refund.
Schedule PC, how does that work?
This is a vital mechanism that allows estates to notify the IRS of a potential future deduction and claim a potential refund related to contingent expenses or claims that are not yet deductible because they haven't been paid, or the amount isn't certain at the time the Form 706 is filed. Think of unresolved lawsuits against the decedent, contested creditor claims, or even the potential need for future administration expenses related to ongoing matters.
So it's like putting the IRS on notice that you might have a deduction later.
Exactly. You file Schedule PC with the original Form 706, or possibly later, before the statute of limitations expires. You identify the contingent liability or expense and estimate the potential tax reduction. This preserves the estate's right to claim those deductions and receive a refund later, even if the normal statute of limitations for filing an amended return, typically 3 years from filing or 2 years from tax payment, might have otherwise passed by the time the contingency is resolved and the expense is actually paid.
That seems incredibly important for preserving rights when things are uncertain.
It is. You file the Schedule PC as an initial notice, potentially update it with partial notices if things develop, and then file a final notice claim for refund once the expense becomes certain and is paid. It's important to note, though, that filing a Schedule PC does not suspend the IRS's review or examination of the rest of the Form 706, nor does it prevent the issuance of a closing letter for the non-contingent parts of the return. It's a specific proactive mechanism designed solely to preserve future deduction opportunities related to uncertain items while allowing the rest of the return administration to proceed.
Got it. So Schedule PC is the way to handle those lingering uncertainties without losing potential tax benefits down the road. Wow. We have covered a lot of ground today, really peeling back the layers of estate tax and discovering the powerful tools hidden within, well, maybe not hidden, but certainly embedded within Form 706 and its rules. From significant exclusions like the basic exclusion amount and the really strategic play of portability for married couples, to powerful deductions like the unlimited marital and charitable deductions and deductions for debts and expenses, and then those intelligent valuation choices, alternate valuation if markets dip, and special use valuation for farms and businesses. Plus the vital compliance steps and payment management strategies like installment payments that can literally save an estate millions or keep a family business afloat. It really is a comprehensive set of options, isn't it? Designed to help you preserve your legacy.
It truly is. And what's fascinating here, I think, is how the seemingly complex and, let's face it, often daunting structure of estate tax law actually offers these specific, well-defined avenues for strategic planning. These provisions, the exclusions, deductions, elections, they aren't just bureaucratic hurdles. They are powerful tools built into the system to allow for intelligent wealth transfer if you know how to use them.
Tools, not just rules. I like that.
Exactly. The ultimate lesson, perhaps, is that proactive engagement planning ahead and making informed choices around your estate can significantly impact your family's financial future. It can minimize the tax burden and maximize what truly passes to your loved ones or the causes you care about. And this, I think, raises an important question for you, our listener, to consider.
Yeah.
Have you recently reviewed your own estate plan with these specific tax-saving strategies in mind? Have you considered portability, QTO trust, charitable planning, valuation options, and ensuring your executor will have the information and flexibility needed to navigate these rules effectively? Are you truly positioned to preserve your legacy as you intend?
That is definitely something to mull over as you go about your day. Really practical call to action. That's all the time we have for this deep dive into estate tax planning strategies based on Form 706. Until next time, keep learning and keep growing.